Hi, you're welcome to this episode of Accounting Principles, and the reference textbook is the 17th Canadian edition, Fundamental Accounting Principles, Volume 1, by Larson, Dieckmann, and Harris. The topic today that we'll be looking at is the adjustments. In one of the previous episodes, we had looked at accounting cycle, even the trial balance, and today we'll take it from there. So you may make reference to those episodes on trial balance and on adjustments for financial statements. Here we are going further to look at each adjustment with example, the depreciation, prepayments on end, and accruals. So we're going to look at that in this episode. Adjusting accounts is important, and it's an important procedure to making the accounting or the financial statements look true and fair. And that is very important. It's one of the concepts of generally accepted accounting principles, GAAP, that accounting should overall be fair. It should be true. It should really ensure that users can make decisions, fair decisions, with the good knowledge of the position of the business. So accounts are adjusted at the end of each accounting period to bring an asset or liability account to its proper amount. Adjusting entries also update the related expense or revenue accounts. These adjustments are necessary for the preparation of financial statements, because it is these financial statements that you publish to users. We had looked at in one of also the previous episodes, we had looked at the users of accounting information, the internal users and the external users. So adjustments come in different types: the prepaid expenses, depreciation, on end revenues, accrued expenses, and accrued revenues. Prepaid expenses are costs paid in advance of receiving their benefits. They are recorded as assets. As these assets are used, their costs become expenses. These costs expire with the passage of time or through use and consumption, e.g. insurance supplies. So prepaid expenses are amounts or costs paid in advance prior to their usage. So when you pay for something before you use it, it is a prepaid expense. Example is insurance, rent that you pay for before you use it, bills, all forms of bills, or even supplies that you pay to get before you use it is revenue, is prepaid expense. So it is an asset because it's like you are tying your capital down prior to the time you would use it. So it is an asset because you own that thing. You own the right of use, in quote, of that thing. So as you start using that thing, that prepayment gets reduced, and the expense of usage will be increasing. Basically, it means that when you buy something in advance or you pay for something in advance, it is recorded as an asset. And as you start using it, it is going to be reducing, right? So that asset account is going to be reducing, whereas as you're using it, it is building up your expense account. So basically, if you have a rental prepayment account, so as you're using it month by month, the premises, so the expense account of rent would be going up, while the prepayments you had made would be going down. So prepaid expense example: on January 1, a company purchases an insurance policy that covers 3 months and costs 1,800. Note, 1,800 is for 3 months. The policy will benefit the company for 3 months and would be expired at the end of 3 months. The cost of the policy should be spread over the time period it benefits the organization. That's matching principle. So January, the first month, is 600. The second month, February, is 600, and the third month is 600. The old prepayment, when you first made it, is 1,800 prepaid insurance account, debit side. Remember, an asset is debit. We had talked about it in a previous episode. Accounting principles, you may look at it in the previous episode. We looked at the items that should be in the debit side. Asset is one of them, and items that should be in the credit side. Liabilities are one of that. So prepaid expense, the entry to record the purchase of insurance would be prepaid insurance 1/8. So the cash account goes out, is credited. Remember, in the debit and credit, the entry that is given is in the credit. The entry that is receiving is in the debit. Cash is being paid out, so it's going out. So credit cash account. Prepaid insurance is debited. It is an asset account. That's when it happened on January 1, when the payment was made. So the entry to record the expiry of insurance for January. So at the end of January, that's January 31, insurance has been used for 1 month, which is 600. So expense account, insurance expense account is debit, but expense is a debit entry. So it's debited. Now prepaid insurance that was in the debit side 1/8 before is now reducing by that 600 that has been used from it. So prepaid insurance would be credited, insurance expense account would be debited. So as you use something up, it is expensed. And from the prepayments you had made, that one would be reducing. When asset is reducing, it's credited. When expense is being opened, it is debited. The second month, that's February, expense account is again used, insurance expense debited. And prepaid insurance is further reduced by 600, which means at the end of February, balance remaining in the prepaid insurance account will be 600. That is meant for March. So March prepaid insurance account would be finally used up, credited. The insurance expense account for March would be 600, debited. That is how to do prepaid expense account. So the next one is depreciation account. Depreciation overall is reduction in value of assets. Companies acquire assets such as equipment, buildings, vehicles, and patents to generate revenues. These assets are expected to provide benefits for more than one accounting period. Depreciation is the process of allocating the cost of assets over their expected useful life. The expected useful lives. So depreciation is based on the matching principle, where the cost of an asset is matched over the time the asset helped earn the revenue, which means matching concept, as you benefit in a period, you match it with cost of earning that revenue in order to ascertain your profit or otherwise in that period. So as you use the asset up in generating revenue, in selling, in providing goods and services, as you use up asset, that asset is helping you to generate revenues. But the cost of using that asset is the depreciation. The value of reduction or decline on that asset is the depreciation, which means depreciation is a way of allocating or spreading the cost of an asset over its useful life. So example, on January 1, 2014, a company purchased a piece of equipment for 72,000. The equipment is expected to have a useful life of 4 years and have a residual value of 8,000. So now that means the total amount you will use on that asset is 72 minus 8,000. You bought it for 72. At the end of 4th year, it will still have value of 8,000. That means you would have had 72 minus 80,000 used up, but spent 4 years. So, or it's expected to spend 4 years. That means each year would be 72,000 minus 8,000 divided by 4 years. That gives you the amount of depreciation per year. So the entry to record the purchase of the equipment. When you purchase the equipment on January 1, equipment is an asset. When it comes in, it's debited. And cash is paid out for that transaction. When cash goes out, because cash is also an asset. That means cash is given out, is paid out, so it's credited. Equipment that is coming in, that is being received, is debited. So the entry in every transaction that is receiving is debit. The entry that is given out in any transaction is credited. So cash is given out, equipment is received. So equipment is debited, cash is credited, right? You get that? So then the depreciation expense account. The entry to record depreciation at the end of the first year would be depreciation expense, equipment, and accumulated depreciation. We have opened equipment and cash account already. So depreciation expense account. So 16,000 was the answer obtained here per year. So that means at the end of 1 year, the depreciation expense account would be debited by 16,000. It is an expense. It is using up something. Expense is cost incurred for using up, cost being used up in the process of delivering goods and services, or providing goods and services rather. So 16,000. Now accumulated depreciation will now be in the credit side. This will be building up each year that you use up the equipment. So the equipment expense account is debited. The accumulated depreciation, accumulated means total depreciation as at the time of recording, would be 16,000 credit. Then debit expense account. Example, the entry to record at the end of the second year, that's another 16,000 depreciation expense account, and depreciation accumulated is 16,000. This is the total that has been reduced from the asset, which is 32,000 total. So in year 2 ending, 16,000 was used, which means 32,000 is in the credit side to reduce the value of asset. So depreciation expense is in the debit. Expense is debited always. Increase in expense is a debit entry. In year 3, depreciation expense account will be debited further, and addition of 16,000 would be to the total of accumulated depreciation you had before, which means 32,000 plus 16,000, which means at the end of year 3, 48,000 has been used up as accumulated depreciation on the asset. Then 4th year, the very last year, depreciation expense, the asset is further used, so 16,000 used. Then accumulated depreciation will further increase by 16,000. So debit depreciation expense, always expense is debited. Then accumulated depreciation is credited by 16,000 to show the total depreciation of 64,000 at the end of year 4. So the balance sheet looks like this. That's extract of balance sheet. At the end of year 1, the asset at cost remains the same, 72,000 for each of the years is the same. Then accumulated depreciation at the end of year 1 was 16,000. At the end of year 2, it had increased to 32,000. At the end of year 3, the total depreciation used had increased to 48, and at the end of year 4, the total depreciation had increased to 64,000 to give us the net book value at the end of year 4 to be $8,000. Unearned revenues, cash received in advance of providing products. So before you provide services or goods, any cash that is received from the customer is an unearned revenue, and it is a liability. So the company has an obligation to provide goods and services. Unearned revenues are liabilities. As products and services are provided, the amount of unearned revenues would be reducing. So when you provide the service, the earned revenue will increase. But before you provide the service, the unearned revenue you have collected, the amount you have collected from the customer before you provide the revenue is unearned revenue. It's in the credit side, well, it is a liability. So when you provide the revenue or the portion of the revenue, that unearned revenue would reduce in the debit side. Then earned revenue account or income account would be credited, because that is an income or a revenue. So example, on March 1, A company received a 12,000 payment from a customer for maintenance services to be provided over the next 2 months. The entry to record the receipt of cash would be debited because cash comes in. The entry to debit is cash because cash is received. Then unearned revenue, the liability account is credited. On March 31, 6,000 of this revenue had been earned. That means you provided 6,000 portion of the revenue. So unearned revenue account would reduce. 6,000 will be debited, and maintenance revenue is an income account. This is a liability account, unearned revenue. It will be debited, but it reduces now. Your liability has reduced because you've provided 6,000 portion of the liability. Then maintenance revenue is a revenue or income account. It's credited. It is always a credit entry. Income account is a credit entry, so you credit it by 6,000 because you have provided this service. Unearned revenue would reduce because you have covered, or you have provided this portion of the liability. By April, another 6,000 had been earned. So that means 6,000 maintenance revenue account will be credited. Unearned revenue account, which was a liability, would now be debited. That means your liability is reducing, but your income is increasing. Now, the next one is accrued expenses. Costs incurred in a period that are both unpaid and unrecorded. Accrued expenses, you have not paid it, but you have incurred it. Any expense that have been incurred but not yet paid. Example, heating and lighting that you have used up but you have not paid. Wages and salary at the end of the month that you have not paid. Or rental expense. Any expense that you have used up, that you have incurred, that you have not yet paid, is an unearned or is an accrued expense. It is a liability. Example, interest can be accrued, wages can be accrued, rent can be accrued, taxes can be accrued. Accrued expense, example, on December 31, 1,200 of interest has been accrued on a company's bank loan. The payment of the interest is not due until January 1. So December 31 entry to record is interest expense 1,200. It's an expense. Expense is always debited. But because you have not paid it, it is an interest payable account. This is an accrued interest account. So it is interest payable, which is a liability. You are owing it, but it is already incurred. And remember, when we talked about matching concept, regardless of when you pay an expense, or regardless of when you receive income earned, it must be recorded at the time they are being incurred or earned respectively, and matched all together. So interest expense that you have incurred must be debited even if you have not paid it. But because you have not paid it, it is interest payable. If you pay it, it is cash that will be credited. Interest expense will still remain debited, but you have not paid it. So interest expense is debited, interest payable is credited. This is liability account, this is expense account. This is expense, this is liability. In December, a company incurred 3,700 of utilities expense. The company had not received the utility bill on December 31. So the entries to make here are utilities expense 3,700, and which is an expense account, but you are owing it yet to be paid. So accounts payable account, which is a liability account, is credited by 3,700. The fifth one, accrued revenues account. Revenues earned in a period that are both unrecorded and not yet received in cash. You have earned revenue, you have provided the services, or you have sent the goods to the customer, but you have not received the money from the client or from the customer. That makes it an income accrued. It's the customer that is owing it. You have earned it already, but it's accrued yet, so it's an asset, it's a current asset. Adjusting entries must be made to record the revenue for the period and the related asset at the balance sheet date. Examples of accrued revenues could be fees earned. You have earned the fees but it's not paid yet to the organization, or interest earned, or rent earned. This rent is rental income. For instance, if you sublet a part of the business premises to a tenant, that amount you'll be receiving from that tenant is rental income. So if it is already due but the tenant has not yet paid the organization, it is an example of rent income earned or accrued revenue. So example, on December 31, 16,500 of consulting fees have been earned but have not been recorded or billed to the client. The entry to record the accrued consulting fees earned would be account receivable is the customer or the client that is owing is a debtor, and that will be recorded as an asset. Then consulting fees earned, this is a revenue. So you have a debtor that has not paid, is an asset, debited. This is an income you've earned already, even though the customer hasn't paid yet. Yet, it doesn't mean income recognition principle would apply. You have to still record it as revenues earned. Now, the final part is the adjustments and financial statements. Adjustments are only made when financial statements are prepared. They affect both the income statement and balance sheet, but do not affect cash. Adjustments through accruals and prepayments, depreciation, they do not affect cash because cash is not affected. For instance, depreciation is reduction in value of assets. Cash is not being paid or received. You are just using up your asset and it is reducing value. Or adjustments through prepayments and accruals. Cash is not affected, but income statement will be affected because income statement uses accrual basis of recording. Balance sheet would also be recorded because of the adjustments. Unadjusted, okay. Here. So trial balance. There was the previous episode. One of the previous episodes already has been released for trial balance. You may look through it for reference. So unadjusted trial balance is a listing of accounts and balances that is prepared before adjustments are recorded. But adjusted trial balance is the one that is prepared after you have adjusted the accounts. We just talked about the adjustments. So the trial balance you prepare before the adjustments is the unadjusted trial balance. And as the case suggests, adjusted trial balance, on the other hand, is the trial balance you prepare that takes into consideration the adjustments you have made. So, financial statements. Adjusting entries bring the accounts up to date. The adjusted trial balance is used to prepare the financial statements in the following order. First, the income statement, then statement of changes in equity, the balance sheet, and statement of cash flows. In reference, you may look up the financial statements that has been recorded also as one of the episodes in this channel. So you may look it up to make reference. We talked about the statement of changes in equities, income statement, balance sheet, and statement of cash flow. And finally on this episode, I'll be looking at correction of errors. Briefly, I will not go fully into details because I've talked about trial balance before and some errors that will not affect trial balance agreements. You may look it up. So, but for the purpose of rounding off this concept, errors found before posting. Draw a line through the incorrect information and insert correct information above the original entry. Errors found after posting. Two alternatives to doing that: prepare a single correcting entry and reverse the original entry and record the correct entry. Should you have any question on this episode or on any of the previous episodes, please make a comment to write your question. It will be responded to accordingly. Thank you very much and see you in the next episode. Thank you. Bye.